Welcome, everyone. In this episode, we're going to be talking about the changes that have been proposed in the 2026 federal budget in Australia in relation to discretionary trusts. This is, in my personal opinion, one of the biggest bits of tax reform that we have seen announced for a very long time. It's going to have some serious consequences. And some of those things we're going to talk about today. So again, I've got Alex with me. Alex, welcome.
Thanks, Venkat.
You've probably had trust yourself in the past, so you'll have a bit of personal experience on these matters. But some of this is seen as controversial. But my basic take on this, before we get into the details, is that essentially this brings on par the equity of tax in the sense that no matter whether you earn your income through a trust or a company or an individual employee, the amount of tax you pay is now going to be roughly the same if these changes actually pass Parliament, which we should mention, they haven't yet passed Parliament. They're all just budget proposals.
Yeah. But I think the changes will pass because I think, Labor being Labor will say these changes are all in the one bill, which is also going to include the sweeteners to the taxpayers. If you don't pass this, you deprive the other taxpayers of the certain benefits they were providing. So therefore, it forces the opposition not to oppose the changes. That's the way they're going to do it. But I think look at the proposals, there's always been the dichotomy between income from labour, income from investments, and you can never tax the same. And maybe rather than saying, okay, tax income from investments the same as income from services, why don't we switch the other way around for the hell of it?
Yeah. Yeah, in a sense, though, a lot of income in Australia is also earned through trusts or companies operating as trustees of trusts and so on. So I think there's an element here that I think it is a little bit about what the government's own argument is. We're doing this to try and bring the neutrality between the type of vehicle through which you earn your income. I think, and what impact it'll have in investments, I think I'm not exactly sure at this stage, and we'll have to wait and see.
Sure, but taking that point further, I think if you're going to have this neutrality of structures, well, just look at a trust and say a trust is purely and simply an asset protection vehicle. That's it. You can't use it for purposes. Leave it at that. Much like a company trading vehicle. So rather than mix asset protection and tax consequences, separate the two and say, okay, trusts can only be used for. And then you say, okay, that's primarily, if you think about it, that's what a lot of people use them for today. They don't use them in theory to traditionally tax split. It was always at the start, I want to protect my assets against mongrels like you that would sue the pants off me.
Exactly. Well, I mean, I guess at the end of the day, if you wanted to use trusts just for that purpose, even today, you could do that. And the tax changes proposed in the budget would have no influence on that. But of course, what has happened over the years, as you've just alluded to, is that trusts have been used for income splitting, for, in some cases, circular distributions, meaning one trust distributes to another trust distributes to another, and eventually the money gets lost in transit. And it becomes very difficult to tax these entities as well. And I guess some of the examples are, for example, 100,000 earned by a salaried person. Approximately 25% tax will come out of that, right? By the time you do their marginal tax rate, etc. But if you had 100,000 earned by a family of, say, mum and dad and two kids, and assuming the two kids are adults, you could basically split that four ways, and the amount of tax would be hardly 5,000 in total. So you can achieve a much lower tax outcome by using it. So the income earned through a trust has far less tax consequences than income earned through an employee. And part of the process, I think, here is about equalizing that. And of course, there's a lot of people unhappy about that because they're going to have to pay more tax than before.
Well, I think the other option is to say limit the beneficiaries that you can distribute to. Because if it's certain trusts, you got a range of trusts. You've got investment trusts, you've got trusts set up by high income earning professionals, you've got trusts for businesses. If you look at the high income earning professionals, you could say, well, you earned all that income, it's yours. Go back to the basic concepts. It's income from services. If you set up a trust, the family will limit who you can split to and can only go to you.
Yeah. I suspect, though, wouldn't that make the whole system, which is already incredibly complex, more complex? Isn't the idea of taxing them at 30% going to make the system simpler?
It sounds good in theory, but I think, if you start with a clean slate, just do away with trusts for the purpose of income tax purposes. Is my simple view.
Well, that would be
These
ideal, but
for
that's far more radical than what the government's suggesting.
but we're radical speakers, you know that, Venkat. We're not the traditional speakers. We speak our mind.
Yes, well, I personally, I totally agree with you. I think it would certainly make the whole system a lot simpler. But at the moment, I guess this is what we've got. Now,
Look at what's come out on last couple of Tuesdays ago. So we'll just go through what's
let's
proposed.
go through what's proposed. Yeah, good idea. So, in terms of the key changes, what we've got is,
Yeah.
firstly, that these changes come into effect from the 1st of July 2028. So they're quite a long way away.
Yeah.
The CGT changes and negative gearing changes we talked about in the last video, they come in a
Yes.
year earlier in 2027. So these changes come in 2028. The trustees basically, or rather, let's go back one step, Alex. What's the current system?
Yeah.
Let's quickly explain how tax gets paid on the current system.
Okay, so when you look at the current system we have with trust, well, trustees have choices: either retain it and pay 47% tax on the retained income, or find beneficiaries within the trustee to allocate or give a present in time or distribute to give it to them, basically. And then they pay tax on their marginal tax rate, subject to whether they are under a legal disability or not under a legal disability.
So this is the beneficiaries.
Correct. So if we do that, then that's the problem. Okay. So from a current tax point of view, we pass on the liability to the beneficiaries. And again, as you said, if we can find beneficiaries that can utilise the lower tax rates, well and good from that point of view. All right. We've also tended to use companies to come in, because company tax rate could be 25 or 30. So let's say we're 30, which is better than 47 cents on the dollar. So
Correct.
we had the ability to, what people now call bucket companies, to sort of bucket or dump the income in there.
Correct.
So they were with the income, and that was always the way that people did it. But now changes, it's limiting those abilities to do it. As you mentioned, they're going to bring this minimum tax of 30%.
Correct. So the minimum tax then is that the trustee now will have to basically pay a flat rate of 30% tax, as we're showing you on the graphic here, a flat rate of 30% tax on the trust's taxable income, not on its, actually, it's not really clear whether it's going to be on the trust's in net income of the trust estate, which is the trust law version of the income, or whether it's going to be on net income. I suspect it's going to be on the tax law version net income calculation.
Logically, to be consistent with other tax laws, because we always pay tax on we call taxable income, not counting income.
Correct.
So it's going income is per tax law.
So that's the big change. The big change is the trustee in the past would pass on, as Alex has already mentioned, would pass on the income from the trust to various beneficiaries, assuming they're adult beneficiaries, not under any legal disability, etc. They would pay tax. Whereas now, the tax liability rests entirely in the hands of the trustee. The trustee pays a flat 30% tax. Now, let's talk very quickly, Alex, about why 30%.
Well, I think 30% was really, you look at the corporate tax rate.
That's
for
it.
Companies, tax entities, and it's like 30% is the current rate for companies. Let's just apply that rate. Okay, so not 47, not a lower rate, but sort of 30 was
correct.
Sort of
Correct.
rate.
So part of, I guess, what the government is trying to do here, or what this policy will achieve if it's implemented, is that a lot of people will just close up trusts and move into companies.
Correct.
Because if you're trading in a company, as opposed to just an investment company, then you actually pay 25% tax. So you've got a bigger incentive to actually switch to a company, pay out dividends to people as you need to, and those dividends get taxed as normal. But you can also accumulate your wealth at 25%.
Correct. Because trust is always a problem that we make a profit, profit for tax on it. We have to distribute, and that's
to hand it out. Yeah.
So, you now look at a trapping vehicle and say, okay, let's flip it on its head and use, as you said, a company structure to be an investment vehicle. So in the old days, before a lot of the change came in back in the early 80s, there were investment companies run by families. So we're just going back to that scenario. So, and I think that's what you need to look at. When you look at all these tax changes, don't focus on the change, but look at say, okay, this is the change. To look at ways we can, if you like, not circumvent, that's probably the wrong word, but let's see how we can use the changes to do things better with current structures or new structures.
Yeah. And look, sometimes some people are going to pay more tax. And some people are going to end up paying more tax, but it's also the same people who have had tax breaks all these years. So ultimately, it's not people are sort of upset about having to pay more tax, but in a way, this is tax that they haven't paid all these years, which they really, some people would argue, employees might argue, why have you been not paying those taxes when we have? So it's a bit of that rebalancing act, and not everyone's going to agree with that, but that's what it is.
You got this, Venkat, but I think you take the view that when you look at it, if you have the trust that's got a lot of investment income, what you think is, okay, if I'm going to be taxed on income, how do I reduce the income within the trust? And I encourage people to do, say, leverage, but not sort of negative, but to a positive. So
exactly.
I mean, you grow your wealth that way.
There's always other ways, and if it means that you get 5% less than what you did before, it still means you're getting 95%. So, and I think that's.
I think they've got to look at the after-tax income they accumulate and how they grow that, rather than thinking, I'm paying 30% pay to the government. We all say that, but here's an opportunity to do things slightly differently.
Correct.
You just use the current structure, so don't be put off by it. Is my view.
Yeah. So just going back to the changes, highlighting quickly what they are. Any beneficiary that's not a company, so if an individual gets paid by a trust, they actually receive credits for the tax paid by the trustee, but only up to 30%.
Correct.
So in other words, just like a franking credit, if you had a company and you got paid dividends, you get a franking credit. The same system will apply, except that if your tax rate is, if the beneficiary has a tax rate less than 30%, those are not refundable, which means that you can't get a refund for the difference. So
it's the original system.
Which is exactly. And actually, all this means basically is that if you earn income from a trust, it will be taxed at a minimum 30%, no matter whose hands it goes to.
Correct.
So the easy way to circumvent that, if you like, would be just to start a company and pay dividends to only those shareholders that you want to pay the dividends to.
Comes a fully franked dividend, partly franked dividend, you get the credits from 16% rate will drop into 15%. Then
correct
credits.
Because the frank. Sorry,
you just readjust.
Because the franking credits from a company will always be refundable.
That's why for the accounting business students, this is wonderful. It creates, if you like, opportunities in going out to the workforce that AI can't help you with.
We would hope so, Alex. So just very quickly, those credits again are non-refundable. We've kind of talked about that point already. So effectively, there'll be a minimum 30% tax rate. Corporate beneficiaries, as we've discussed, don't get those credits, and essentially they've done that in order to prevent this bucket company thing that we talked about before. Now let's just go back to that for a second. As you mentioned before, what you could do at the moment is you distribute money from your trust to everyone so that you pay the minimum amount of tax. And then whatever's left, you can chuck into a company. And the most tax you'll ever pay is 30%. And so that's always been, that's what we call a bucket company, because whatever you can't give to people, you throw in that bucket, right? And that bucket keeps accumulating. So the advantage of that has been that that company would have a tax liability equivalent to the amount of money that it's received. So it would never pay any further tax.
That's right.
Whereas now that company can't claim those franking credits. And so therefore, there's really no point in having a bucket company anymore.
Correct.
Which is what the new changes do. So we've talked about, very quickly, we've talked about what the changes are. Let's quickly talk about what's not yet finalized. And I have taken this from the government's own website, so the audience can see the source of where this comes from. Firstly, this is the big one. The mechanism for collecting the minimum tax has not yet been finalized. So we don't know exactly the mechanics or the administration issues that are going to come with this. Let's have a quick talk about that. How do you reckon they might do that?
Well, I think they sort of have it in a way in some ways, because remember when you have beneficiaries that are under legal disability, under 18, bankrupt or mentally disabled, the trustee has to pay their tax on their behalf. So there is, in a way, mechanism to do that.
Yes.
And the done it is that when you make the distribution to those that are under legal disability, they get the notice of assessment. And the notice of assessment, but the trustee picks up the tax bill.
Yep.
So there, sort of the mechanism, they're just going to finesse it a bit to say, it applies to everybody, etc. So the way I sort of see it practically working is, okay, the trustee or the trust has worked, okay, 100,000 is taxable income, say, it says, okay, I'll pay 30%. So my simple view would be that when you lodge a trust tax return, you can have to tick a box now that says, is the trustee liable to pay tax? And you've got to tick a box, yes. In the past, you always said no, because you always distributed. So if they yes, then I would think a note of assessment is going to arrive and say, you give me 30% of the 100 grand, 30 grand, pay that. Then what's left? What you like? And I think in simple terms, that's probably the mechanism that they'll use.
Yep. So notice of assessment now will actually go to the trustee.
Correct.
In the first instance.
Yeah, this is your tax liability. Now you sort that. Then the PAYG instalment systems, etc., will flow on from that.
Yep. The other thing is, what is not yet decided is how the trustee will use franking credits that exceed the minimum tax liability. So just quickly explain that, Alex, in terms of what that means.
Well, when you say it exceeds if the credits exceed the minimum tax liability, it's likely, I don't think it ever will.
If it does, then they're not refundable. So I guess that's the.
But see, if your view is you're on 18%, and the view is that your distribution's tax at a minimum, okay, you're not the difference back anyhow.
Yeah. Okay.
So there, you're lower than 30, it's not relevant from your perspective. So you're always going to pay a minimum of 30. That's it. So, that's on the distribution to the beneficiary. So if you're on the top tax rate, you've got to pay the top up. If you're under 30, you won't get the difference back.
Yep, that's it. And finally, rollover relief will be provided to support restructuring. So if people do want to go from, particularly small business entities, if they want to go from the existing trust structure and go into a company, they will basically not incur any CGT, which they otherwise would, in order to do that. So in a way, that's kind of like your transition arrangement, right? Is that if you do want to restructure, and certainly if this passes Parliament, then people have, 2 years now, really, to restructure. And there will be ways that people, so particularly small businesses, won't be disadvantaged because they can structure into a company, as we've discussed, and it doesn't impact them terribly much. So,
the final about trust, sorry.
Oh, yes.
The final point about trust was really about people worry about testamentary trust because they sort of see this as a de facto death tax.
Yes.
But trust is set up within your will. They come into effect on the person's death.
Yes.
And a lot set it up is they wanted to protect the asset from the surviving spouse remarrying, the children that have liability issues, divorce, or business perspectives or business risks.
Yeah.
So those things were useful from that point of view. So I said that we go back to the basic trust, and therefore asset protection. And
exactly.
Fine. And now they're saying that, okay, if it's not a fixed trust, but it's a discretionary testamentary trust, the same rules apply. And that's something, for a lot of people, they say, well, I'm not dead yet, so I don't care about it. I'm young. Older people, I think that's why you've got it in different age life cycle groups, are going to have to worry about different aspects of the trust law. Gone beyond.
No, but this doesn't apply. The proposed changes don't apply to testamentary trust, do they?
They do. Because if they're you still have it. So that's why there's this issue. You've got to convert it to what they call a fixed trust, which means they get it. With the discretionary testamentary trust, you had a discretion to how much you gave, because that only arose on death. So that,
right. Well, which I guess makes things a little bit more concrete for the person leaving behind the money anyway, because you get to choose. You're not leaving it to the discretion of somebody else. And that's probably what you want anyway.
Well, I think, for a lot of the older people, they want to pass their assets to the next generation or to the spouse. They worry about that. So that's why I think a lot of the older ones have to learn to ski, which is spend the...
but what I'm saying is, if you do want to rule from the grave using your trust, testamentary trust, then you're better off having it in a fixed entitlement anyway, so that somebody else can't, after your passing, have the discretion to distribute differently.
Yeah, that's right. And I think that why it's become an important issue is because they talk about this big intergenerational passing of wealth from the to the next generation or the next generation. So that's going to create the problems. You see about, do I trust my children, my grandchildren, whatever it may be? And that's why they always a lot of people have this idea of trust. And
But I guess, Alex, humanity's always had that problem
yeah,
about trusting your kids and your grandkids.
yeah,
Okay, so finally, a couple of other issues just to wrap this one up. Um, Trusts are not required to be registered. Now, to me, this is a big one. I think this is a big one because if you're going to administer the system, at the moment, trusts aren't registered anywhere.
yes,
Companies are registered. You can go and look up where a company's registered. You can go and look up who the directors are, or the shareholders are, and all the rest of it. Trusts aren't registered. The only way we know about a trust in Australia is if they lodge a tax return.
correct, correct. Or same partnerships.
Yeah.
You're not legal entity structures, which is trusts. It's open up, and the only way we sort of track partnerships is we rely on you, Venkat, to lodge a partnership tax return.
Yes. And trusts,
Trust.
again, don't have to lodge, whereas partnerships still have to lodge one if they have income. But a trust
Yeah.
doesn't have to lodge one until it actually starts to have income or has an income that's distributed to somebody. So so what will be interesting to see is whether they do come up with a system of registration of trusts. And just as importantly, are they going to have the deeds of the trusts registered in some ways as well? Because at the moment, when the tax office comes knocking, you could pull up the deed that you've got in your top drawer, or you could pull up the deed you've got in your bottom drawer, and they wouldn't know.
Right, that's right.
So I think that will be an interesting element going forward. Another point that we need to think about is this minimum 30% tax rate. So essentially, it means that, as we've already discussed, it brings it on par with companies. What happens with unpaid present entitlements? So if the trustee pays the 30% tax, right,
Yes.
and makes that distribution to, let's say, a company, but then keeps the money and doesn't distribute it out and makes it an unpaid present entitlement, how are they going to treat that? Because at least 30% tax has already been paid on it. So do we need to worry so much about unpaid present entitlements anymore? That might be something to consider.
I think it doesn't really matter because I think the key words are present entitlement. Once you said you have it, I don't no matter whether you pay it or don't pay it. You said you have it, so therefore I think that will trigger the tax liability. If you haven't paid it, it's got to record it in your accounts as unpaid as liability. But I don't think whether it's been given or not given, the tax consequences will still be liable, because otherwise it's an easy way to get around the problem.
Yeah. But what I'm saying is I think that in a way it doesn't also matter, because at least now you've already collected the minimum 30% tax out of that distribution. So whether that's retained or not as an unpaid is less of a problem. So they can stop stressing about unpaid entitlements now if there's a minimum 30% tax. And the last point there, Alex, is that we've got some trusts will be able to switch. And this is something we've already talked about, I guess. But if this does pass Parliament, which we suspect it probably will, some people may want to just restructure into companies or whatever other forms that suits their needs.
That's right. And I think, depending on your circumstances, whether you're a business, whether you're a high income earner or an asset protection person, whatever, you're going to have to rethink, the type of income that comes into the trust. We can change the nature of the income or whatever, or reduce the income, whether by leveraging or whatever. So it's smaller, still positive, not negative. So it's still positive, and as a way to say, okay, if I can manage on less income or do with a small amount of income, but focus now on the growth side, then it's maybe one option. So you sort of got a trust. I want to reduce the taxable income. It goes to capital. Then I've got the other side to worry about in the future of the capital gain rules. But I think you also got to be mindful. These are rules brought in by the government of the day. When you retire in 20, 30 years time, whatever, who knows who the government of the day will be?
Exactly.
Now the rules, well, then we're in a total different ball game. So I think you've got to don't feel these rules are locked in place forever. Capital gains and 41 odd years now, but we've changed along the way. And again,
we have
all change.
We have, and the reality is, anytime there's a change, there's going to be some bunch of people that will win and some bunch of people that will lose. And I guess my view on this is, and this is the utilitarian view, and perhaps you might call this a very lefty view, Alex. But as long as the change is benefiting more people, and the cost has been borne by a small number of people, and in this case, the cost is being borne by the top end of town, and if more money is then effectively flowing. But one of the things the government's got to demonstrate is how they're going to make that money flow back into hospitals and education and public services. That's something they've never been very good at doing, but that's something that hopefully they will do. But yeah, and finally, I think the last point I want to make here, Alex, is that, there's a lot of misinformation out there, with people just saying, ridiculous things that have no real meaning in actuality. Things like, Albanese owns 47% of your company and stuff like this, so I would encourage people, if anyone's watching this, to seek out formal sources of information, go to the actual budget papers, go to the actual legislation proposed and so on, or speak to advisors who actually know what they're talking about. And certainly don't be listening to people who are effectively influencers on social media or whatever, spreading misinformation. But go to the source, try and listen to people who are providing a relatively neutral opinion and are telling you about what the changes actually mean, which is what we've been trying to do on this channel.
Right. So we're just providers of information and trying to explain to people what these rules mean for themselves and what they should and for the future.
And as we've discussed, any change is going to cause winners and losers. And what we've got to look at is, are the overall benefits going to be, if we all just sit back and think, oh, what's in it for me, then society doesn't quite function that way.
Yeah, that's right.
So.